Hello everyone, my name is Anjani Kumar Khetan. I am based out of Bangalore in India. Today we are starting a new series which deals with how to deal with the decommissioning liability. We will understand what this concept is all about and how the accounting literature under IFRS and Ind AS gives you guidance in terms of how do we deal with that. So how do we deal with this decommissioning liability? That is the subject matter of our discussion. Now, before we deep dive into the topic per se, let us first understand the context and what is the meaning of these decommissioning liability, what is the issue, what the standard gives you the guidance. So just to set the background, it is possible that an entity may have certain obligation because of which an entity may require to dismantle, remove or restore, let's say, an item of property, plant and equipment after a certain period of time. So for example, let us say this entity has an oil rig. Now, there may be a requirement that say after a certain period of time, in this example, let's say after 10 years, the site on which this oil rig is there may be required to be restored back to its original positions. So therefore, you will require to dismantle, remove the existing structure and the machinery and restore the location to its original position. Now, if that be the case, and this obligation may arise because of either the legal or the contractual obligation which the entity has, say, on account of a local law in the geography in which the entity operates. So therefore, if you have a scenario like this, where the entity has such contractual or legal obligation to dismantle, remove or restore items of PP&E like this after a certain period of time, let's say 10 years in this example, then we can say that these obligations which the entity has is very much falls within the definition of what is called as decommissioning liability, restoration liability, or liability of similar nature. Now the question is, if an entity has this kind of a liability, what the standard says, what kind of a guidance is given in the IFRS and Ind AS literature to deal with such liabilities. Now, as we know, liabilities, provisioning for the liability is something which is captured under IAS 37 or under Ind AS 37 from an Indian perspective. Likewise, property, plant and equipment is captured from an IFRS perspective in IAS 16, whereas in the Ind AS perspective, it is IAS 16, which covers the accounting for property, plant and equipment. So let us see what, first of all, the PP&E standard tells you. So if you look at paragraph 16 of IAS 16 or Ind AS 16 from an Indian perspective, this paragraph tells you that cost of a property, plant and equipment, for example, in our case, the oil rig. So when you are initially recognizing such property, plant and equipment, the cost of this property, plant and equipment will also inter alia include the initial estimate of the associated cost of dismantling and removing that property, plant and equipment and restoring the site to its original condition if that entity has already incurred such obligation to dismantle and remove the property, plant and equipment and restore the site to its original condition. So if this obligation is already incurred and that obligation can be contractual or legal, then in that case, paragraph 16 says that the cost of the PP&E will include the initial estimate of such liability. Now, either when the asset is acquired or as a consequence of having used that item for a particular period of time. So what these two pointers tells you So in our case, if the life of this oil rig is less than 10 years, now it is possible that the legal or constructive or this contractual obligation arises at the very beginning when the oil rig is installed or is brought into use. Or alternatively, let us say when you started using the oil rig, there was no such obligation, but in between, later part, during this 10-year period, let us say after 3 years, at the end of 3 years, if such obligation arises, that is the second point it says, or as a consequence of having used the item during a particular period. So during this period, you come to know only at the end of the 3rd year that there is a liability which exists. So these kinds of liabilities are very much covered within the ambit of paragraph 16 of IAS 16 or Ind AS 16, thereby meaning that cost of dismantling these kind of property, plant and equipment and restoring the site to its original condition, initial estimate of that either at the initial recognition or at a subsequent point in time during the life of the particular asset, that needs to be included as part of the cost. How? We will see by way of a case study. Now, similar guidance is also given in IFRS 16 or Ind AS 116, which deals with leases. Paragraph 24 of these two standards also says that the ROU asset, the right of use assets, which you set up under these two standard under leases, that will also include these type of the estimated liability on such leases. Likewise, paragraph 45 of IAS 37 or Ind AS 37, which deals with provisioning, it says that for measuring it, the IAS 37 or Ind AS 37 gives guidance of measurement of such liability, and it says that where the effect of that, when you are measuring, so in our case, you have a long period of 10 years, 20 years, 30 years. The liability arises at the end of these period. So what paragraph 45 of Ind AS 37 or IAS 37 says, that where the effect of time value of money is material, then the provision which you will recognize at this point in time, the amount which you are required to incur is at the end of 10th year. So let's say if 10 million is required to be incurred at the end of 10th year, and if the time value of the money is material, which invariably it will be if it is a long dated asset, which is where the liability arises at the end of a long period of time, then when you are recognizing the provision, you should do the discounting, and the present value of this obligation, which arises at the end of the 10th year in our example, needs to be accounted for at the initial recognition. And this is exactly what we will illustrate on the next slide by way of a case study. So let's see here. So how do you account for such kind of a cost at initial recognition? Let's take a case study. Now assume that City Oil, this guy, City Oil is a company which has acquired an oil rig at a cost of 100 million. So the cost of this oil rig is 100 million, and at the date of the installation, the entity has a legal and the contractual obligation to decommission this oil rig at the end of 10 years in accordance with the local legal framework, and the entity estimates at the initial recognition itself, it estimates that the decommissioning cost, which will happen only at the end of 10th year. So you have the installation happening at this point in time. Obligation for decommissioning is at the end of 10th year. And the entity estimates, as given in the third point, is that at the end of year numbers 10, the entity will incur 14 million of decommissioning cost. That's the estimate which the entity is making at the initial recognition. Now, we have seen in the previous slide that if you have a long period involved, then the measurement of the liability as given in paragraph 45 of IAS 37 or Ind AS 37 says that you need to discount this liability of 14 million to arrive at the present value and then record the liability at the present value at initial recognition. Now, in this case study, it is given that the applicable discount rate is 10%, using which you will need to discount this 14 million. Of course, this is given in this particular case study. So, given this fact pattern, how would you go about computing the dismantling cost that needs to be capitalized on initial recognition? And how do you arrive at the depreciation charge and interest expense in subsequent period? And how do you determine the carrying amount of the decommissioning liability in subsequent period? These are the questions which we need to address. And in this case study, we will deal with each one of these questions one by one. So, first thing first, in this case, the cost of the oil rig is 100 million without considering the decommissioning liability. And the gross amount of the estimated liability at the end of the 10th year for decommissioning this oil rig is 14 million. And we know applicable discount rate is 10%. So therefore, what is the present value PV factor? Present value interest factor at 10% after 10 years will be 0.3855. Well, how it is? 1 divided by 1.10 to the power 10. That will give you the computation of 0.3855. Again, from the PV factor table also, you can directly get this number. So, given this, now paragraph 45 of IAS 37 tells you that this 14 million of liability needs to be discounted at this PV factor. So what would be the present value of the obligation? Present value of the obligation will simply be 14 million into this PV factor, B into D. B into D would be the present value of the obligation, 5.4 million. And therefore, this 5.4 million will be added to the cost of the oil rig of 100 million. And what you will recognize at initial recognition, when the oil rig is installed, you will not recognize 100 million, but you will recognize 100 plus 5.4 million. 105.4 million would be the cost of PP&E that you will recognize at the initial recognition. Let us see what else we have to see. So, as I said, the total cost to be capitalized on initial recognition will be this 100 million plus this 5.4 million, aggregating to 105.4 million. The provision is required since why we need to provide for this 5.4 million? Because the obligating event, what triggers this 14 million of the liability at the end of the 10 year, the trigger for that is the installation and use of this oil rig. So installation of the oil rig is the triggering event which causes this particular liability, and therefore you have a present obligation at the time of installation of the oil rig itself, and therefore you will need to provide for this, of course, at the present value of the liability, which is expected to be incurred at the end of the 10th year. We will continue our illustration here and get to answer to other questions here in this particular case study. Now, so we have seen in the previous slide, 105.4 million is your cost of PP&E. So given this information and the computation which we did, initial recognition will be 100.4 million, consisting of 100 million plus 5.4 million of your decommissioning liabilities present value. So now that your PP&E is at 105.4, so your opening balance of the PP&E at the beginning of the year will include 5.4, and therefore 105.4 million would be your opening PP&E. Assuming the SLM method 10 years life, this divided by 10 would be your annual depreciation every year. So 105.4 divided by 10 will give you SLM annual depreciation of 10.54 million. And therefore, each year, this minus this will give you your closing WDV. This becomes opening WDV of the next year. Then again 10.54 depreciation. WDV at the end of year number 2 will be this minus this. Eventually, at the end of 10th year, the asset is fully depreciated. So that's how your depreciation schedule and PP&E and WDV will look like over the 10-year period. Now, what about 5.4? You have only recognized 5.4 million of the liability corresponding to the present value. But you will actually need how much? 14 million at the end of the 10th year. And therefore, what you will do, you will now apply the concept of EIR, effective interest rate. You will have to, so the 5.4 would be your opening liability, opening decommissioning liability. Now, you have to do unwinding of the interest. And therefore, at the discount rate of 10%, you will start recording interest expense and increase the closing value of your decommissioning liability. So, on 5.4 million, which is the opening balance of the liability, 10% of this, 0.54 million, would be your interest expense for year number 1, and therefore at the end of year number 1, your closing decommissioning liability will be 5.4 plus 0.54, which is 5.94, and this becomes opening decommissioning liability for year number 2. Again, 10% of this opening 5.94, you have to record interest expense and increase the liability for decommissioning expenses, and therefore at the end of year number 2, your decommissioning liability balance carrying amount will be 5.94 plus 0.59, which is 6.53 million. Likewise, you will continue calculating interest expenses during the 10-year period, aggregating to 8. What is this? Total is 8.6 million as 10% on opening balance of each of the year. That's how you will compute. Now, if you see, you have, by this process, you are increasing the provision. Provision is getting increased every single year. Provision increased from 5.4 to 5.9, 5.94, then 6.53, 7.18, aggregating to ultimately what you need is 14 million. And this 14 million will be the amount which will be used to pay off your liability at the end of the 10th year. So provision is increased over time as the discount unwinds. Now, the total, if you see, 5.4 million plus 8.6 million is the, so for this unwinding, what is the entry which you record? Interest expense debit in P&L, credit decommissioning liability in the balance sheet. So for every year, you are recording this amount as a debit to interest expense and credit to decommissioning liability. And therefore, at the end of the 10th year, your decommissioning liability will be 5.4 plus all of these 8.6 million. And if you add all of that, 5.4 plus 8.6 will eventually give you total 14 million of the closing decommissioning liability. Right? That's the way this you will be doing the accounting. And then basically, if you see, very important consideration which is given in this particular box is this. Though this is unwinding of interest, when you look at IAS 23 or Ind AS 23, which deals with borrowing cost, this interest cost cannot be capitalized. So capitalization of this unwinding of interest is not permitted under IAS 23 or Ind AS 23. This will be just a P&L charge as your unwinding of interest. That's the way the accounting will happen. And therefore, if you see journal entries, as I already explained, at the beginning, at initial recognition, you will record PP&E at 105.4, consisting of bank payment of 100 million for that rig, oil rig, and 5.4 million for the decommissioning liability, present value of the liability which you set up. And then in the first year, you will record how much of the depreciation you will record. Every year is 10.54. So 10.54 would be the depreciation. So depreciation expense in P&L, credit PP&E. And for unwinding of this amount, 0.54, as I already explained, in debit interest expense in P&L, credit decommissioning liability. So increase this decommissioning liability. Now, these two entries will be repeated every year. Every year you will record depreciation of 10.54. Every year you will record unwinding of interest. Of course, the amount will change as computed in this slide. And therefore, these sets of entries will be repeated in subsequent period. Eventually, you will have 14 million of the liability and asset balance will get reduced to 0. That's the way you have to do the accounting for such decommissioning, your liability. And at the end, in year number 10, the balance of this 14 million which you have, this will be used to discharge your liability. So assuming your liability is, the actual liability also turns out to be 14 million, then what you will do at the end of 14th year, the end of 10th year, you will debit the decommissioning liability for 14 lakhs, credit bank, and make payment for your obligation. Now, this is what the simplistically you have to deal with the decommissioning liability. Now, let us look at a practical insight. Okay. By the way, this is not there in the standard. As I also mentioned, that decommissioning cost or the associated liability may arise subsequently in the life of the asset. So, for example, we said that if you have a 10-year life, initially this obligation may not exist. Let us say a legal framework came in between. At the end of third year, a legal framework came, and because of which now you have an obligation at the end of the 10th year. Now the problem which comes is, okay, you may determine what your liability is based on what is your expected amount to be paid at the end of 10th year. But the question is, that amount, would you record in the future period only, or you will record a combination of both future period as well as the past period? Let us see this with the help of an example case study that will make things easy. By the way, as I said, there is no clear-cut guidance given in the standard for these practical issues. Let's see how much provision needs to be capitalized. Similar example, you have a nuclear power plant. This plant has a life of 30 years, and the change in the local legislation happens at the end of 10th year, not at the beginning. So in the 30-year life, the change is... So what changes are coming up? Because of the change in the legal framework at the end of the 10th year, an obligation of 9 million arises in respect of decommissioning cost relating to this nuclear power plant. Now the question is, how do you deal with such? Let us say this 9 million, assume, is the present value of the obligation 10th year. Now the question is, how much of these amount recognize? Also, how much would you recognize and capitalize at the end of the 10th year? Now, there are two possible ways as to how much provision can be capitalized. The first approach says the entire 9 million which you are determining is capitalized and depreciated over the balance 20 years life. The other approach says only 6 million. See, you have a life of 30 years. 10 years already gone by, 20 years are yet to go. So 10 divided by 30 is 1/3 period, and 20 divided by 30 is 2/3 period. The second approach says that you capitalize only 2/3 of the 9 million, and the balance 1/3 of the 9 million, that is 3 million, you charge it off in the P&L because that amount relates to the past period. There are two alternative approaches, but so if you see here, that's what it says. By applying the first approach, entire 9 million is capitalized and depreciated over 20 years. But in second approach, only 6 million is capitalized and depreciated over the 20 years. The remaining 3 million in this second approach is recognized immediately in the current year's profit and loss account because it relates to the past period. As I said, unfortunately, neither of these two approaches are prescribed under the authoritative literature under IFRS or Ind AS. But the recommendation is that the first approach, should be the preferred approach. Why so? Because actually the situation or the new information has arisen at the end of the 10th year. And therefore, this liability should be recorded go forward only. Again, as I said, both approaches are there, but recommendation is that one should apply the first approach. Okay, so we will continue with this. This is what I wanted to cover in this particular video. Now, this was a simplistic explanation of how you deal with the decommissioning liability. But the question may also arise that your estimate may change over a period of time. So what happens if you initially, in this case, you estimated 14 million liability. Now tomorrow, 3 years down the line, that 14 million liability changes either way. Either it increases or decreases. From 14 million, let's say it becomes 20 million. Or from 14 million, it gets reduced to say 6 million. Just because, let us say, there are better technology available using which the cost can be reduced. Now, what happens in those cases? If you have a scenario like this, when there is a change in the original estimate of the decommissioning liability, how to deal with it? That is something which we will look at in the next part of the video subsequently. So this series will continue even in subsequent periods as well. This is the first video of the series wherein I have introduced you to how this accounting for the decommissioning liability is required to be dealt with under IFRS and Ind AS. Now, I have given my social media contacts here, both the YouTube channel and the LinkedIn. Feel free to connect with me. Put in the the comments of this particular video if any specific topic you want me to cover. I will try my best to cover those topics as we go along. Please subscribe to the channel. That will keep me motivated to come out with quality stuff. And we will, as I said, we will continue to continue with this particular series. I will bring in more videos which will give better and deeper insights into this topic. So this is what I wanted to cover for this video. We'll take a pause. Thank you for your attention, and I will see you in the next video. Take care. Bye for now.